The exact same investment can be a total non-issue in one account and a serious compliance problem in another, held by the same person on the same day. In the last video, I covered what actually makes something a PFIC. In this one, I am covering where they tend to hide because it's not just about what you're invested in, it's about where you're holding it. Quick context: I'm a CPA here in Australia and an enrolled agent in the US. This video is general awareness of where PFIC exposure tends to arise, not a personal advice. Whether your specific holdings are affected depends on your actual accounts and structures. Let's start with the simplest case. Any Australian ETF, index fund, or managed fund you hold personally, outside the company, has no special protection at all. If it meets either of the two PFIC tests we covered last time, it's a PFIC full stop. This is the most common way US citizens in Australia end up with PFIC exposure simply because these are some of the most ordinary and widely recommended investments here. If you watch the superannuation video, you already know the classification fork: employee benefits trust versus foreign grantor trust. It matters here too, in a big way. If your super fund is institutionally managed and classified as an employee benefits trust, the PFIC sitting inside it generally aren't separately reportable. The trust wrapper itself is what the IRS looks at, not each underlying fund. But if your fund is an SMSF or otherwise reclassified as a foreign grantor trust, that wrapper is ignored entirely. You're treated as directly owning every PFIC inside the fund, and each one needs its own separate reporting. The exact same 50% contribution question from the superannuation video ends up deciding your PFIC exposure too. If you watch the PTY Limited video, you know a company can be left in its default corporate classification or elected into pass-through treatment. This is exactly where the choice matters for PFICs too. While a company stays a controlled foreign corporation, there's a rule that generally prevents the same investment from being hit by both the CFC rules and the PFIC rules at once. It means if you own a controlled foreign corporation, otherwise known as CFC, you are not double classified. But the moment that company is elected into pass-through treatment, often done specifically to get out of the CFC and guilty rules we covered, that protection disappears. You end up treated as directly owning whatever passive investments sit inside the company, PFIC rules, and all. The very election that solves one problem can walk you straight into another. Quick recap. So, personal accounts have no protection at all. Super depends entirely on how your fund is classified, and a company's protection can disappear the moment it's elected into pass-through status. One more place this shows up, and then two genuine exceptions worth knowing. If a foreign trust, like an Australian family trust, holds PFICs, that exposure doesn't just stay with the trust. It's generally attributed out to US beneficiaries in proportion to their interest in the trust. And if you're treated as the grantor of the trust, Something we covered in the PTY Limited videos discussion of corporate trustees. You can be treated as directly owning everything inside it, PFICs included, even if you've never personally touched those investments. Two genuine pieces of good news. First, there's a small balance exception. If your total PFIC holdings stay under a certain combined threshold, you may not need to file the reporting form at all. Though that exception disappears the moment you actually sell or receive a large payout. Second, some countries have retirement accounts that are explicitly protected from PFIC reporting under their tax treaty with the US. UK pensions and Canadian retirement accounts, for example, have clear treaty language covering this. Australia doesn't have that. Our tax treaty was written before compulsory super existed, so it's simply silent on this. Which is exactly why super's protection depends entirely on classification, not on any treaty promise. The same investment held in different places can mean completely different outcomes. Which is exactly why a general answer isn't really possible here. It depends on your accounts, your super classification, and your entity structure all at once. If you want to talk through where your own holdings actually sit, I offer a fixed fee PFIC Exposure Clarity Call, a scope conversation to identify likely exposure across your accounts, not a full engagement. Links in the description.